The gold market is currently experiencing an unprecedented period of disruption, primarily driven by a significant shift in global gold flows. This disruption has manifested in a dramatic increase in the cost of short-term gold borrowing in London, with weekly lending rates soaring to approximately 10% annually, a stark contrast to the typical 2 to 3%. This surge is directly attributable to a substantial gold rush towards the United States, as evidenced by an 88% increase in COMEX inventories since the election in November. The scale of this shift has caught many market participants off guard, leading to a series of cascading effects throughout the global gold market. At the heart of this gold migration is the looming threat of potential tariffs imposed by President Donald Trump. Traders are proactively moving their gold holdings to the U.S., aiming to capitalize on more favorable domestic gold bar premiums and exploit arbitrage opportunities. This substantial influx of gold into New York has led to a depletion of London's gold reserves, creating considerable bottlenecks and causing delays of several weeks for gold withdrawals from the Bank of England's vaults. The situation has become so acute that some market participants are reporting difficulties in sourcing physical gold in London, a city that has long been considered the global center of the gold trade. This market disruption carries significant implications across various sectors of the gold industry. Commercial banks, refineries, jewelers, and manufacturers who typically rely on borrowing gold to avoid storage costs are now facing substantially higher borrowing rates. This increase in costs is likely to be passed on to consumers, potentially affecting demand for gold jewelry and other gold-based products. Additionally, the market is experiencing heightened price volatility, with gold prices already surging over 8% this year and reaching a new record of $2,893 per troy ounce. This volatility is creating both opportunities and challenges for investors and traders in the gold market. The imbalance between U.S. and London gold stocks is causing considerable market disruptions, and the price spread between COMEX gold futures and London spot gold has widened, creating unusual arbitrage opportunities. This situation has attracted the attention of sophisticated traders who are seeking to profit from these market inefficiencies. However, it has also raised concerns about the overall stability and efficiency of the global gold market, with some experts warning that these imbalances could lead to more severe disruptions if left unchecked. Despite the ongoing market turmoil, gold demand remains robust, as evidenced by the World Gold Council's report of record-high gold demand last year, with total demand rising to 4,974 tons. This strong demand is being driven by a combination of factors, including economic uncertainty, geopolitical tensions, and concerns about inflation. Investment demand has seen a 25% increase, driven by a surge in demand for gold bars and a renewed interest in gold exchange-traded funds. This trend suggests that investors are increasingly viewing gold as a safe haven asset in times of economic and political uncertainty. Furthermore, central banks have maintained strong demand for gold, purchasing 1,045 tons last year, marking the third consecutive year of purchases exceeding 1,000 tons. This continued buying by central banks underscores the enduring appeal of gold as a reserve asset, particularly in an era of heightened economic uncertainty and geopolitical tensions. Many central banks, especially those in emerging markets, are diversifying their reserves away from traditional currencies like the US dollar and towards gold, viewing it as a more stable and reliable store of value. Looking ahead, the unprecedented level of political and economic risk created by the Trump administration's policies is likely to enhance gold's appeal as a safe haven asset. The ongoing trade tensions between the U.S. and China, coupled with broader geopolitical uncertainties, are creating an environment where investors are increasingly seeking out safe haven assets like gold. While gold prices are expected to continue setting records in 2025, it is unlikely to match last year's impressive 26% increase, as some of the factors driving the current rally may begin to moderate. John Reed, chief market strategist at the World Gold Council, emphasizes the significant disruption that the current situation is causing to the gold market, highlighting the imbalance of gold between the US and London as a key factor driving up borrowing costs and creating challenges for market participants. He notes that while the London gold market remains liquid, the current situation is testing its resilience and highlighting the need for greater transparency and efficiency in the global gold market.